So I just got done watching stupid reels, and we just came across some pretty big news that I want to share with you here in this video. And I also want to give you a big warning for tomorrow, because the economic data we're going to get, the JOLTS job openings, has huge implications for Tesla stock, for the broader markets, and for your portfolio. Let's start this video off with a bang. Cruise is now going to test their autonomous vehicles in Seattle, Washington. It's going to be a small fleet of vehicles, just a couple of them, to try to see how the vehicles actually operate in Seattle. Now, Seattle poses different challenges than maybe you will see elsewhere. It's got weird kind of slopey hills. Obviously, that's a thing in California as well that's quite popular, and Cruise doesn't have an issue with that most of the time. But Seattle also has very different weather than somewhere like a California will have, so it's a little bit unknown how these vehicles will perform. Specifically, Cruise vehicles will operate in sections of downtown Seattle, Capitol Hill, Queen Anne, Fremont, the University District, and West Seattle. These vehicles will have a driver behind the wheel. Just in case something does go wrong, there will be somebody behind the wheel, just so you guys know. I find this strange, just given how many issues we have seen recently in other areas for Cruise vehicles stopping in the middle of intersections. We've seen videos of that. Cruise vehicles driving into wet concrete. Cruise vehicles hitting your first responders on the side of the road. All of these three specific examples have happened within the last 2 or 3 weeks, but Seattle is still allowing them on the road. Now, do not be confused. This is great news if you're a Tesla stock investor. This is great news for me personally. I want to see Cruise and Waymo be successful, because the more successful Cruise and Waymo is, the more regulatory processes are going to become easier for Tesla to push their autonomy through. If Cruise and Waymo are doing what they're doing now, which Tesla's going to have better technology, isn't it going to be easier for Tesla to get to the same point as Cruise and Waymo? Obviously, yes. So you don't want to see Cruise and Waymo do poorly. So this is actually great news for Tesla stock. Tesla's main advantage over Cruise and Waymo is Tesla's aggregating all of the data now. So Tesla's not going to have to do what Cruise is doing right now. They're not going to have to test out their autonomous driving software in different cities, because all the cities are essentially being mapped as we speak every single day. So Tesla's going to have the actual deployment advantage over Cruise and Waymo, but the more cities Cruise or Waymo can get into, the better it is for Tesla. For the regulatory process kind of part of it. But something else that I don't think a lot of people actually pay attention to. This is also positive for Tesla, because it really forces Tesla to innovate with full self-driving as fast as possible. What I mean by that is the best technologies in the world, your best smartphone, your best computer, your best TV that you have today did not start as the best product. What happens? Well, you get a lot of competition, and innovation needs to happen or your product will die out and fail. Well, if Tesla had this kind of competition for the last 5 years, we would already have robotaxis out on the road. We didn't see that much competition for a long time. So Tesla didn't have to work as fast as humanly possible to create full self-driving. Well, now they have to. They really have to. And that's why you're seeing such a large investment now with NVIDIA's GPUs, a $300 million cluster, I believe the biggest in the world. Most speculation is reasonable to assume it's the biggest cluster in the world, used to train full self-driving and full self-driving neural nets. But also Dojo. That's also something that is specifically created for full self-driving. I know there's data aggregation and other things. Tesla wants to use these tools for, but that's the main one. And competition is actually a good thing for Tesla. Let's now get into what I really planned on going over here in this video before this news broke, and obviously we had to cover that as well. It's this. You're going to get the JOLTS job openings tomorrow. You're expecting 9.465 million. Last month's reading was 9.58 million. So you're expecting a drop of about 100,000 job openings. This would be great. The lower the better is what I'll say here. If the job openings come in higher than 9.46 million, you're in for a big problem in the markets. A very big problem. Because why? Fed Jerome Powell has been very clear. To get rid of inflation and to sustain a period of maximum employment and price stability, which he says at every Fed meeting, that's his dual mandate. You need to see inflation get killed. You need to see something break most of the time. In the 70s, they didn't kill inflation enough. They started cutting rates. Inflation came right back and exceeded the prior round's highs, close to about 20% at one point. Now, the dynamics are different, but the point is the same. You have to see pain somewhere to kind of shift the mentality of the markets, of the economy, that prices will not continuously just keep going higher. So you really need to kill inflation, is the best way I'm going to put it, before the Fed does ultimately cut rates. You need to see some kind of crisis. You need to see a recession. You need to see something. Now, the Fed has been very clear. You can see loosening of the labor market two ways and two ways only. Either people lose their jobs and unemployment rises, and that would be a recessionary environment. That is your hard landing. That's not what the markets want to see. Or you can see job openings come down. If job openings come down to, call it 4.5, 5 million, the Fed will start cutting rates, because that means just people are not looking to hire. There's not as much frugality in our markets at that point, or in the economy, I shall say. So the lower the better. And preferably, if you fall a lot, that would be really good. If you rise and you break, 9.8 million or so, and even go higher than that, the markets are going to have a very rough day tomorrow. And I think this could actually move the markets pretty big. Now, throughout the rest of this week, we're also going to get more economic data. Wednesday, we're not going to get much. You are going to get the German inflation rate, as well as corporate profits, GDP growth rates, a lot of revised data from last quarter. On Thursday, you're going to get the PCE index. Your core PCE index is expected to be the big one month over month. You're expecting that at 0.2%. Last month's rating was 0.2%. That's 2.4% on a 12-month annualized basis. That's okay. It's not quite under 2%. But you really don't need to see it at under 2% necessarily to get to 2% inflation, especially on your headline. Now, obviously, you want to come in at 0.1% because that is 1.2% on a 12-month annualized basis, but 0.2% is okay. Personal spending, that's expected at 0.7%. Last month's rating was 0.5%. Personal spending, we can see good spending as long as inflation continues to fall. Then you're just at that point seeing a strong economy. It's not necessarily inflationary just because spending is high. That's actually what has kept us out of a recession. Now, the data point coming on Friday is going to have the most relevance to the JOLTS job openings, and that is the non-farm payrolls, but specifically the unemployment rate. Because like I just said, you can either see loosening of labor conditions by the unemployment rate rising, or the JOLTS job openings falling. So on Friday, you're expecting the unemployment rate to come in at 3.5%. If this comes in at 3.7%, 3.6%, that's going to be pretty good news. If the unemployment rate stays flat at 3.5% and JOLTS job openings show a big decline, that's probably your best case scenario. That is really reinforcing that soft landing. And then non-farm payrolls, you're expecting 170,000. Last month's reading was 187,000. So you are expecting a little bit of softening month over month here. And this is as to be expected. I think you're probably going to come in around 150. If you come in under 100,000, markets might not like that all too much. Because again, that's kind of supporting that hard landing narrative. But the problem that I see in the markets is a lot deeper than the actual just economic data. I think the economic data is really your big catalyst that can fuel big moves in the markets, but there's underlying things that are currently happening. And this is probably the most worrisome thing I have seen in quite a long time. Now, let me show you what I mean. So, in October of 2022, October 31st specifically, of 2022, Bank of America put out their typical note as they do at the end of every month. Well, take a look at this chart. This was your big tech mega caps, your market caps in this light blue. Well, this dark blue line is your central bank liquidity, essentially the balance sheet. And what happens throughout time, ever since '08, you have basically correlated the Fed's balance sheet to the performance of the markets. Almost perfectly. Almost perfectly. There's no better correlation actually out there in the markets than the Fed's balance sheet and big tech or just big companies in general, or just call it the stock market, right? Just make it simple. They correlate almost perfectly since 2009, 2008. Well, look at the new note that just came out. This is going to shock you. Look at this. Compare the same charts. But look at August. Look at right now. Look at the Fed's balance sheet that has continued to fall after that slight boost in March, right? When kind of the Fed had to inject a lot of money into the banking system. Well, you've been falling on this dark blue line. But what has happened with the markets in this time? You have done the total opposite of what the Fed balance sheet has done. So Bank of America is making the argument right now that this should not be happening. And I think that makes a lot of sense. So you're really vulnerable here, as this is the largest divergence you can see on this chart. Last time this happened was the run-up at the end of 2019, as you can see where my cursor is right here, heading into COVID. The markets vastly outpaced the Fed's balance sheet. And then what happened? The markets fell and came right back down to the same level the Fed's balance sheet was at. And then you've seen the COVID lockdown and the stimulus, Fed's balance sheet increased, and it was off to the races. And they basically matched up the entire time. The second largest divergence that you have seen with this particular chart is right before the markets rolled over at the end of 2021, where the markets had that one last kind of breakout rally in a lot of your specific big tech names. I remember at the time, Apple, Microsoft, your large cap stocks, tech stocks, were the ones that were doing all of the lifting towards like December and January of 2022. And then what happened? You came back down and you matched where the Fed balance sheet was at. And even over the last, call it year or so, year and a half, you've actually been under the Fed's balance sheet as far as liquidity on this chart for most of the time. Back here in August was kind of we did get above that a little bit, but then we just came right back down. So that was kind of normal of what you would expect with this chart. And again, reference this chart right here of what was put out in October of 2022. Well, now look, again, huge divergence. This creates a problem. Now, usually when you get divergences and anomalies happening in the market, like I would call this an anomaly relative to recent history, it usually takes something to actually get the markets to correct this. It usually does not happen on a Monday where the markets are quiet and there's no data, there's no news, there's nothing that happens. But when you get big data points, you can really exacerbate a lot of these moves. Just a data read that seems pretty benign or not all that negative can quickly turn into a 1.5 to 3.5% down day for the markets, because maybe the fall here, as you can see from the charts, is long overdue. And maybe we're way further stretched than we should be. Obviously, there's a first time for everything. So we could hold up here and the Fed's balance sheet could continue to fall. It would just be the first time since 2008, 2009. It's never happened before since the great financial crisis. So this is something that is kind of worrisome if you're in the bull camp or perma bull camp and you think nothing can touch this market. This is something I would point to that is a massive cause for concern. Does that mean you should sell everything? No. Does that mean the markets will crash this week? No. Does that mean the markets will crash in the next couple of months? No. But it means something is drastically different than what we have seen within the last, 15 years or so.
Yes, we've seen yields take a breather today, but the rapid climb we have seen in interest rates. How much pressure does that put on the stock market here?
Yeah, Morgan, I think it does put pressure on the stock market. And not that, even if we trade to 4.5 or something like that on the 10-year, I mean, that's not the end of the world by any stretch. But I think when we think of rates, we don't think rates are going to go a whole lot higher from here. But we certainly think the Fed is not done hiking interest rates. We think that they're going to be higher for longer. And really, when you look at some of the headwinds that are out there, in our opinion, earnings estimates are too high. Credit's tighter out there, and that's not going to change anytime soon. So I think, if we tested the recent highs, we'd have a heck of a hard time getting through that. So we're looking for a pullback from here. We're fading this rally. We've been doing that really on the most of the way up.
Lisa, so what's an investor to do? Because the danger is stocks never have a big plunge overall, and so folks are waiting on the sidelines for something for an entry point that never really arrives. So how do you avoid missing out on the growth potential that exists in certain stocks that might seem expensive now, but they might just sort of wobble over time into being not so expensive?
Yeah, look, I appreciate the challenges of market timing, and it's one of the reasons that we advise our clients never to try to do that, that you've got to have a strategy where you're dollar cost averaging in, and it's really just a question of your conviction. If you have low conviction, as we do today, we're encouraging our clients to dollar cost average in over a period of the next 12 months. If you're more bullish, you would dollar cost average in over only 3 months. But right now, our best advice is, if you want that market exposure, if you're afraid of being out of stocks, that perhaps a more balanced risk approach would be to own the equal weighted S&P 500 that doesn't necessarily carry some of the sector concentration and the name concentration that we're seeing in that market cap weighted index, which, albeit is dominated by those Magnificent Seven, but those Magnificent Seven may not be magnificent forever.
And Scott, why do you think we're going to start to feel the lag effects of the rate hikes more in Q4?
Well, John, I think that really we're starting to feel them. It's been slow. I think a lot of this deficit government spending that we've seen has pushed the economy along for longer than what we thought maybe it would a year ago. But I think that when these rate hikes, as these rate hikes kick in and the economy slows, the market's going to stumble here, and it's going to stumble further. But I think that's an opportunity. And so what we've been trying to talk to our clients about is, let's say the market's down to 4,100. Maybe we see it a little bit lower than that. That's an opportunity. You need to be ready for the pullback, because you want to step in when the market's down, when you're a little nervous about stepping in. when it's tough to step in. So that's what we've been talking to our clients about. We don't want to buy stocks after a gigantic rally and it's near the top of the range. That's not the time to buy stocks. You want to do it when you're looking out a couple of years when they're down. So we've been sitting on some cash. We backed off of technology. We backed off of equities in general over the course of the last couple of months. And we're parking that cash really in short-term treasuries. And should we get this pullback that we expect, we're going to put some money to work at lower levels.
Bank of America says the put-to-call ratio has been soaring recently, and they expect the SPY could fall to about 420. So you know how we like to do it here on this channel. I'm going to give my opinion when it was not asked, because hopefully you guys appreciate opinions, and that's hopefully what you get out of these videos is different opinions, especially these warning kind of videos or just talking about upcoming catalysts. I just want to share my opinion. I could be right, I could be wrong. I'm not a financial advisor. But what I did notice today, which was hard to not notice, is the volatility that you've seen in the S&P 500. The NASDAQ, same story here, but we're just looking at the SPY. Big down moves for no reason. And then subsequently, big up moves for no reason. Every hour and a half or 2 hours or so of the trading day, you've seen these very weird kind of moves. I think this means we're going to get a big move coming tomorrow, and there's going to be a lot of volatility. Now, my personal opinion on the JOLTS job openings is I think the economy is slowing. I know quite a few people that work in restaurants that say, usually any other year, you're busy around this time of the year. The end of the summer, people are trying to, get that one last kind of end of the summer fun in, and restaurants are usually busy. Right now, they're not. And I'm hearing this from multiple people in different areas of my state of Michigan. So I can only speak for Michigan. Let me know what you guys are seeing in that regard around the country, wherever you guys live. Let me know down below in the comment section. So I do think JOLTS job openings are likely to come in maybe 9.3 to 9.2 million. Normally, I would expect that to give you a positive reaction in the markets, but like that clip we just heard from Wells Fargo, they're selling the rallies. And that's kind of what we've seen with NVIDIA. You couldn't have asked for better earnings from NVIDIA, and NVIDIA stock still sold off after earnings. They're selling the rally. So I don't know how the markets are going to react in this kind of market environment. Even on good data, the markets might sell off. Or what is positive for, Fed policy and not getting more rate hikes. Markets could sell off on that. I don't even want to think about if the JOLTS job openings came in higher than expectations. That could be really bad. So that is what I do know is expect a lot of volatility due to some of the disparities and differences that we're seeing in the markets, most notably the Fed's balance sheet and where the NASDAQ is. I mean, again, this should not be happening. At least it hasn't happened to this degree ever before. So I think this sets us up for, like I said earlier, it's a reason for the markets to correct this anomaly or abnormal kind of behavior we're seeing in the markets. A benign data report could give you a big move because these kind of things are happening under the surface. And it's hard to quantify in the moment, but hopefully this kind of data makes it a little bit easier for you guys to understand the move that we do get tomorrow. So that is going to do it for this video. If you guys want my opinion on Tesla as well, obviously, as I say all the time, Tesla is going to move more than the markets and it's going to be more extreme than the markets. But minus any price cut from Elon, I don't expect an epic collapse for Tesla. On any downside, you want to watch that 100-day moving average currently at $222.82 per share. That would be your level of support, in which that was support back here on August 18th. You gapped down under that, and then the next day you gapped above it. And you basically held support the two prior days, the day before and the day after of August 17th and August 21st. That was a Monday. So if you find support there, great. We're back to where we were just about a week ago. If you fall under that, your next level is that 200-day moving average, and that is at $197.30 per share. That's where I think a lot of the selling would really slow down in Tesla, and a lot of the buyers would start to actually step in. If you get down to about 180, like I've said before, that's really your sell your kidney of kind of moment, in my personal opinion. And that's where I would be heavily buying the dip in any excess capital reserves that I had. So that's kind of the way that I'm thinking about this. Until we get the Cybertruck delivery event, which I expect will be very bullish, we're just susceptible to whatever happens in the broader markets. So that is going to do it for this video. I wanted to give my opinion on Tesla. Obviously, don't listen to any of this. Hopefully you guys just like a random person's opinion. Hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. Let me know if you think the economy is slowing down, especially in some of the hottest sectors like your travel, leisure, and hospitality. Do you see a lot of people at restaurants? Do you know people that work at restaurants? Is business doing well? Is it doing poorly? Let me know that information down below in the comment section. If you guys also want to come trade with me live in real time, come hedge out your portfolios. If we do get downside in the markets, well, it's beautiful because we're hedged out. So we're going to make money if the markets rally. We're going to make money if the markets fall. What you want to do in theory is hedge out for that downside. If that big downside does come, take those profits, put it back into Tesla stock at a lower price, and you're smooth sailing when the stock actually does recover, in which it will towards the end of this year and in 2024, because the estimates of 27% delivery growth is far too low, as well as 29% EPS growth. Those estimates are BS. So there is that. Trading community is down below in the description of this video. Click on that link. You will get another link to actually join the programs. But that's it. My name is Michael Tyler. Thank you for watching me today and listening to kind of my rants. And I will see you in the next one.